Are you someone who is just starting out as an investor? Does diving into the world of mutual funds seem overwhelming to you? In this video, we aim to demystify mutual funds for investors like you, breaking down the basics and emphasizing that they are not solely about chasing big profits. We would like to highlight the importance of understanding the fundamentals, the key aspects, and why considering mutual fund is a smart move. Welcome to holisticinvestment.in. IPL and its financial parallels. As April and May roll in, cricket enthusiasts across India find themselves fervently supporting their favorite teams in Indian Premier League (IPL). This annual extravaganza has become a significant part of our lives. Have you ever wondered how the teams were chosen back in 2008? What were the factors considered? Let us look at this in detail and correlate it to personal finance. Team manager versus fund manager. Now, as a cricket team owner, you want to pick the best players to make your team successful. But here is the challenge. There is a huge range of players to choose from, and it is almost impossible to know the past performance of every player in and out to predict future performance. So, how will you do it? Instead of trying to pick players individually, you and your friend pool your resources and hire a skilled team manager. This manager knows the game inside out and can select a mix of players for your team. Good idea, isn't it? Now, the team manager's job is to make sure your IPL team performs well over time. The teams so formed should be equally balanced in all aspects like powerful and reliable batters, good all-rounders, and good bowlers. But is the manager allowed to choose whichever player he or she wants? Can he pay any cost to acquire the service of the player? Definitely not. There is a body called BCCI that governs all such stuff related to the number of players selected, the maximum purse value that can be sent and spent, and the set of players that can be bought. To draw parallels with this to mutual funds, simply put fund manager in place of team manager and SEBI in place of BCCI. Now, coming back to finance, imagine a mutual fund is a tool you can use to buy different things like stocks, bonds, gold, and even a mix of these. It's like a shopping cart for your investment. You can use it to buy big company stocks like large caps, or medium-sized companies, mid caps, or pharma stock, banking stocks, like getting the best and reliable players for your cricket team. You can also let a pro manager decide how to use your shopping cart to make your money grow, aiming for good results. So to keep it super simple, a mutual fund is like a magic shopping cart where you put your money and you can choose what to buy with it, like assembling your dream cricket team with different types of players. Next, we are moving into the true essence of mutual funds. Whenever you invest in mutual funds, do not just think about their returns. Of course, the returns in mutual funds are a shade higher than the rest of the investment options like FD, RD, or PPF. But there are much more advantages in mutual fund which we fail to take note of, like liquidity, flexibility, and ease in transaction. Liquidity in mutual funds. We can easily get our money by selling our mutual fund units. This is handy when we have unexpected financial needs or see good investment chances. Unlike some other investments like fixed deposit or certain bonds, where it would take 2 to 3 working days to liquidate. We can easily liquidate mutual funds anytime without any extra charges. Next, flexibility and versatility. During financial crunches, the option to sell a portion of your mutual fund portfolio offers a practical solution. This flexibility is a stark contrast to the rigidity of selling tangible assets like land or a house, where the sale typically involves parting with the entire property. The inability to sell a fraction of the real estate limits adaptability, making mutual funds a more versatile tool for navigating financial challenges. Next, ease in transaction. Investing in real estate versus investing in mutual fund. Okay, let's say you decide to buy a land or a house. After all the hard work, you had finally zeroed in on a property. Now you go to the documentation part to get the legal rights of the property. You gather crucial documents such as sale deed, previous title deed, property tax receipt, and enlist a registered valuer to assess the property for stamp duty calculation. Next, you pay the stamp duty based on the property value. You sign the sale deed witnessed by individuals and get it registered. It is a long and cumbersome process, isn't it? On the other hand, in mutual funds, once you zero in on the fund, It is just a simple one click. You can choose a registered mutual fund distributor to do it for you, or you can buy it directly. If you are investing in mutual funds for the first time, just two simple steps are to be done. One is completing your KYC, and second is linking your bank account. Afterward, you can utilize the same throughout your lifetime. Next, ease of maintenance and comparison. First, clear cut cost. For instance, in real estate, you pay about 1% to the broker when you buy or sell. Then there is a stamp duty when you buy and capital gains tax when you sell. Plus, there are yearly costs for things like taxes and property upkeep. In certain societies, there might be maintenance cost. Now, with mutual funds, the costs are clear and set and cannot go over certain limits as mandated by SEBI. Mutual fund costs are straightforward. You can read more about how SEBI safeguarding the mutual fund industry in our detailed blog covered earlier. The link is given in the description. Next, clarity. Mutual fund versus insurance company policies. SEBI has established a uniform set of guidelines simplifying the process of evaluating mutual funds within their respective categories and against benchmarks. This standardization ensures clarity and consistency in the information provided by different funds, making it easier for an investor to assess the performance, cost, and risk. Contrastingly, in an insurance policy, the information provided is often unclear. You may hear about a promising return, a bonus, a death benefit, and even a free booster return of charges. However, comparing these features across different policies becomes quite challenging, as there is really no means of comparison nor a body that bats for such regulations. Next, customization. Customization is the key advantage of mutual funds, allowing investors to tailor their investment strategy to align with their unique preference, age, risk appetite, financial status, and goals. This flexibility resembles crafting a personalized roadmap for wealth creation. This is just like how you and your family order food at a restaurant. Each person in the family orders a different variety. Next, diversification. Mutual funds offer a way to create a mix of investments, including stocks, bonds, gold, and real estate in one portfolio. In the stock part, you can have different types and styles chosen by fund manager. Imagine having different chefs who specialize in different cooking styles. Doing this on your own, like buying individual stocks and bonds, would be very time consuming. Mutual funds simplify this process, making it easier for you to manage a variety of investments all in one place. We have reached the conclusion part. Successful investing goes beyond just trying to make money. It means understanding that having access to your money when you need it, that is liquidity, spreading your investment around, that is diversification, keeping an eye on cost, making transaction easily, and making sure your investment give you the money you need is all really important. If we follow these important ideas, we can have a clear plan for our money, making smart decision and work towards reaching our financial goals. Consulting a professional financial planner is the best way to aid you in this process. Happy investing. A detailed analysis on this topic is available as a blog post in our website, and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.